Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. On the show with us today is a new guest to the program, Michael Pento. He's the founder and president of Pento Portfolio Strategies. Mike, welcome to the program.
Thanks for having me on, Colin.
Yeah, for sure. And there's a lot that I want to discuss with you today. Our channel is very much so geared towards the precious metals space and all of the things that are going on in the financial world that could potentially lead to higher metal prices, higher gold prices. I think there's a lot going on in that arena right now. We obviously have the Fed policy, which has started to move towards cutting rates, and also by a different name, quantitative easing seeming to start back up. Let's start there, and I just want to get your opinion on the latest Fed policy and what we have seen from our Fed chair.
Well, first of all, I like to say that obviously the Fed has no idea what they're doing. So if you remember around this time last year, remember the Fed was going to raise rates to 3.5%. They're pretty sure on that. They were going to drain trillions of dollars from their balance sheet through quantitative tightening. And that was going to be like watching paint dry and running in the background. You wouldn't even notice it. You couldn't tell. And then, fast forward a year later, and we have not gotten to 3.5% on the Fed funds rate. We're actually at 1.75% on the Fed funds rate. So they got that wrong, and we're headed lower apparently. And then if you look at the quantitative tightening program, well, that blew up the entire junk bond market in the fall of 2018. So they had to reverse that. And now they're actually not only stopped QT, but they have now gone back into QE. Once again, they're doing $60 billion a month of quantitative easing. So it's just, creating money by fiat credit, electronic credit, and shoving it into the banking system. But they don't call it QE this time for some reason, even though they're monetizing debt like any other banana republic would do. So I don't know why they don't call it QE, except they say it's not really QE because they're trying to boost the stock market and push down long-term interest rates. They're trying to push down short-term interest rates. So if that makes a big difference, it's like me saying I'm not an alcoholic anymore because, I'm not drinking because I want to get drunk. I'm now just drinking because I heard red wine's really good for my heart. So you're still a drunk. So you're still monetizing debt, even though you don't want to call it QE, and you might have different reasons for doing it. What you're doing is you're pushing down interest rates by permanently monetizing debt, just like maybe Zimbabwe would do.
Michael, when one thinks of Fed policy, it's normally in reaction to economic issues, either in the stock market or in the bond market. I think a lot of people are confused looking at the stock market near all-time highs and wondering why the Fed is in a position where it needs to begin accommodating in all these ways. Can you explain what it is that's not so rosy in the picture?
Well, I mean, I hate to get into the heads of the central bankers because it's a very difficult thing to do. Clearly, according to President Trump, this is the greatest economy the world has ever seen. And the stock market is trading at an all-time record high value and a record all-time high valuation. So if you look at my favorite metric is the total market cap of equities as a percentage of the underlying economy, as a percentage of GDP. We're now 1.5 times the size of the underlying economy. And that's crazy. It's never happened before. It almost was this high in March of 2000. It was at about 100% of the economy in 2007, and the average of that ratio is like 0.8. So the value of equity should be about 0.8 times the size of the economy, not 1.5 times the size of the economy. So, what's the reason why the Fed would be going back into QE? Well, the reason is that the global economy is extremely fragile, and Mr. Powell is damn aware of it. So what he's done is he's gone back into QE. He's lowering interest rates because he's desperate to get the yield curve right-sized. So he's trying. What is the Fed's purpose of existence is to protect banks. They're not there to protect you. They're not there to protect your solvency. They're trying to protect Wall Street and Wall Street banks. That's what they're there for. So one of the ways they do that is to make sure that banks can borrow money from you, the lender, and you get screwed by getting very low interest rates, and then they want to loan out that those deposits at a higher rate. That's how the banking system works. Well, it doesn't work very well if they're, getting the same return on their assets, their loans, than they are paying on their deposits. That doesn't really work well for something called net interest margin for banks. So what they want to do, what the Fed is trying to do, is steepen the yield curve and make sure that stock prices go up forever and ever, and we never have a recession forever and ever. Amen. That's the reason why they're going back into these very absurd and ridiculous monetary policies. I mean, to think about rebuilding the balance sheet when it's already $3.5 trillion. The balance sheet of the Federal Reserve went from $800 billion to $4.5 trillion. Then it was down to $3.7 trillion, and now they're building it up again. And to think that 1.75% overnight money is too high, and now you have to go back down towards zero. I mean, this is ridiculous. The 10-year Treasury note is 1.73% as of this recording. How is that? Is that indicative of a Fed that has to panic to try to lower borrowing costs because consumers can't function? Well, I mean, what they're doing is they're lowering interest rates, causing a tremendous amount of new debt to be incurred. They're fomenting and blowing up even higher asset bubbles that are completely in the thermosphere. And this isn't going to end very well at all, Colin.
Mike, the Fed is, or I should say the U.S. has 1.7% is actually relative to the rest of the world paying quite a strong interest rate. They're the last holdout on negative rates. Is it inevitable that we are going to end up in the same environment as Europe and much of the other economies of the world? And what is the end game? What happens after everybody's negative?
Well, you put up a really good point. One of the other reasons, perhaps, other than the inversion of the yield curve, is because the Federal Reserve wants to, and also the President of the United States, really wants the U.S. dollar lower. Remember, the Fed once had a mandate of stable prices, and then that mandate became 2% inflation, and now it's at least 2% inflation. That's the new mandate of the Federal Reserve. So 2% is now a floor, that's not a ceiling on inflation rate. So they're trying to get inflation higher. They're trying to boost asset prices. They're trying to knock down the dollar. One of the best ways to do that is to get rid of those interest rate differentials. So, we have a minus 50 basis point deposit rate for the ECB, European Central Bank. Japan has a negative deposit rate, and that's not really working very well for their countries or their banking system. So, I mean, it probably is inevitable that if the United States GDP growth starts to trend towards zero, and we have a GDP print of in Q3 coming out. It's going to have like a 1.7% annualized growth rate. So we're not zero, but we're certainly going the way towards 1%. And then we would have to lower interest rates greatly to match the other countries. And then you asked another good question: is what happens when we're at zero? Well, we're already at zero in Japan and in Europe. So. And as a matter of fact, the European Central Bank is back into QE again. So they ended their QE program in December of last year. That didn't last very long. They just went back into QE recently. The Japan Central Bank never could get out of QE. And we're back into QE. So, maybe we have all the same monetary policies where you say, okay, we're all close to zero, at or close to zero. We're all in QE. And then you've got a problem. You get this problem. You usually need about 500 basis points of interest rate reductions to alleviate the debt burden, debt service cost on the part of businesses and consumers, and to reinflate asset prices. Well, they don't have that anymore. They only, the Fed, as I said, has 175 basis points left, and there's no room at all in the rest of the world for the most part in the major economy. So the salient question is, central banks, do they have enough ammo to pull the economy out of its malaise? And the other side of that question is, I mean, that answer could be yes, but even if it is yes, what is the other side of that? I mean, how much longer can central banks continue this money printing mirage and not generate runaway inflation? In other words, how much longer do consumers on a global basis still place credit in the fiat currency system? And if you can answer that question, then you can answer the question as to how much longer this mirage, this charade of prosperity can be maintained. And that's where I come in. I manage money for a living, so I model this dynamic to make sure my investors are not hurt. They can hopefully protect and profit from the economy while it's sort of continuing this charade, but then also profit when this charade ends. The question is, when will it end? And the answer to that question is very clear. Whenever we have a recession that blows up the junk bond market, and or whenever inflation becomes intractable. So until those one or both of those things happens, we can continue this charade. It's not a very happy charade, not a very good charade. I mean, the stock market hasn't really gone anywhere for the past year and a half. But we can kind of, trip over ourselves and muddle through and do some asset class rotation and sector rotation. But the truth is, eventually you're going to get a recession, or eventually, or you're going to get inflation. And you could get both, Colin. And when that happens, watch out below. It's all over.
Michael, seeing the writing on the wall, and you're in the business of trying to figure these things out, how much longer can the charade go on? And how do you balance about protecting one's savings without betting against the market and then having to wait too long for that recession to come?
Well, that's the thing. So some people who think like I do will just say, well, just buy gold and short the stock market, or some combination of those things. Well, that's wonderful. But if you're wrong, if you've been doing it the past few years, you might have lost. So for instance, gold stocks are down 60% in the last 8 years, since 2011. Now you have to make close to 100% just to get even, more than 100% to get even. So the thing is that, and obviously if you shorted the stock market, you're most likely down significantly as well. So what do you do if you have to manage money and you don't want to shove your your money in a mattress and then get eaten away with this asinine 2% inflation target, which is way higher than it in reality. And you also just can't blindly buy, FANG, Facebook, Apple, Amazon, Apple, Netflix, Google. You can't just buy those stocks because then or some closet index fund, because then you're going to lose half of your money. That's going to happen. It happened in 2000. It happened in 2008, and it's going to happen again. So, maybe it doesn't happen for another 6 months, but it's going to happen. And who can possibly suffer a third halving of their wealth? And it could be much worse because the conditions extent today are much worse than they were in 2000 and 2008. So, what do you do? Well, I created a model called the inflation, deflation, and economic cycle model, and specifically for this purpose. So I map the economy where it sits along the business cycle, and this way I know, are we in a recession? Are we deflating? Well, then I want to overweight bonds and maybe overweight utilities. So bond and bond proxies work really well. And some gold. Or are we going the other way? Are we growing and are we inflating? Then you want to overweight some high momentum stocks and some high beta stocks and small caps. So that's how you model the economy. And this way, if you model it accurately, you'll get out of harm's way like we did in our portfolio in the fall of last year. But then we also don't just sit there and blindly continue being short. We covered our shorts in January and went longer the stock market, so you get a little bit of the upside as well. That's the smartest thing you can possibly do. And I created this model called the inflation, deflation, and economic cycle model about a decade ago, and that's how we rely on protecting our investors.
Excellent. Well, Michael, thank you for coming on the program. And for anybody interested in getting more information or getting in contact with you or your group, how do they go about doing that?
So the website is pentoport.com, my last name, Port.com. You can also email me directly at mpento@pentoport.com. Also, if you feel like calling the office, I promise we won't bite you. The office number is 732-772-9500. If you go to the website, you could also subscribe to a 4-week, 5-week free trial of a podcast, which I put all of my thoughts down every week on Wednesday, and that's only $49 a year.
Excellent. Well, Michael, thank you so much for coming on the program today. Look forward to chatting with you again.
Me too. Take care. Me too.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?